Thank you. It's great to be here. Joan, why don't we jump right into the topic at hand, the macroeconomy, and more specifically, Blackstone's business. We've written about Blackstone in the past. What's amazing is just the amount of assets that the organization has and the growth pattern of those assets. So 218 billion as of the most recent quarter, up from around 98 billion at the end of 2009. And part of that is asset appreciation, but part of that is inflows from sophisticated investors around the world, sovereign wealth funds, pension funds. Can you just maybe have some opening comments on why the company has been so successful at attracting these assets?
Sure. So just to start with the macro view, as you put it, and to tie in the fact that treasuries are yielding almost nothing today. Most of our investors are pension funds, corporate government pension funds, sovereign wealth funds, and they need to earn, as you would imagine, a return of 6, 7, 8% to meet the demands and promises that they've made their constituents. And that is just not available, and nor has it been in traditional markets, treasuries, high-grade bonds, et cetera. And even today, just buying off the screen high yield will yield you, less than the historical average of treasuries, frankly. So we manage across the different alternative asset classes: private equity, opportunistic real estate, hedge funds, and the high-yield credit area. And so we've just seen increasing allocations to those asset classes. And then specifically as it relates to Blackstone, we really are the only firm with leading franchises across all of those different areas. And we've had a very long track record, over 25 years of outperformance across those. And so the other trend that we're seeing is consolidation to fewer and fewer GP firms, and that's been a benefit. So over the last 12 months, not including any acquisitions, et cetera, we've had inflows of about 34 billion across those asset classes.
That's amazing. Why don't we jump right into some of those businesses from the firm? Maybe we'll start off with the real estate business. We had Steve Schwartzman speak at a grants conference about a month or two ago, and he mentioned that the real estate division has outperformed the S&P 500 by about 1,600 points, which is pretty amazing. And I guess on an annual basis. The trend now is the company is buying houses and then fixing up those houses and then renting those houses. I think the company has now deployed about $4 billion worth of capital, maybe around 25,000 houses. Can you speak about the latest trends of what you're seeing there?
Sure. So in real estate generally, just to distinguish a bit from a traditional REIT buyer, we tend to buy things that need work in some way, shape, or form. So we stick to buying at a discount to replacement costs. We tend to avoid development and is very much a buy it, fix it, sell it model with the ideal hold, somewhere in the 3, 4, 5 year range, although it can be shorter or longer than that, depending. So as you think about real estate generally, the biggest trend has been over the last many years over leverage and no new supply. And for us, that was very fortunate in terms of deploying capital. We have the largest pool of capital in the world in this asset class. We own more, actually, than anyone in this asset class. We raised a $13 billion fund last year, a global fund. So, and that's almost all gone into distressed or stressed assets, mostly until we started buying in housing in the commercial space where Folks were just really over-levered, and banks weren't lending at all in commercial real estate, as you might know. And the dynamics are such that, we would rather buy the 50% leased out building than the 90%, get a lot better price for that. And then as you lease it up, and because you could see the supply coming online and there isn't any or very little, there's more take up than supply, you can have a pretty good idea of what the trends are going to be. About 18 months ago, we, around the entire firm, turned more bullish on U.S. housing and decided to invest in it in almost all of our areas in different ways. But in real estate, we really felt that to have any meaningful investment on behalf of our investors, we needed to set up a company, which is what we did. So we formed a company called Invitation Homes, and we teamed up with a very experienced group. We deployed folks into locations around the country, developed software to really understand the markets. We agreed we would only buy post-foreclosed homes. We didn't want to foreclose homes. And we would invest about $15,000 each home to fix it up and then lease it out. So we've now deployed about $4.5 billion, a little more than $4.5 billion in capital over the last year. And the lease up has been quite strong. I mean, housing, the cost to rent a home is actually about 30% less than to rent an apartment. And so, there's quite a lot of demand. Folks need a place to live. A lot of people can't afford to actually buy a house. We get questions often about whether we are driving pricing up. And so we've looked in every market, like how much are we buying versus the market. And if you look at the country as a whole, we bought 20,000 out of 5 million sold. But even as we looked in each neighborhood, we were never more than 2% at any time. So, and we've been quite disciplined about pricing, so I don't think that's been an issue. But, we were willing to put big risk capital at work, and it's just probably a little longer term investment.
I'm assuming you're facing more competition trying to buy those houses now as other private equity funds and other pools of capital bid for those houses?
So I'd say two things. There's really no one at our scale buying it. So in that sense, no. But I would say, generally speaking, housing prices are up across the country from the time that we started. And so, if you think about it in innings, we're probably fifth inning through our strategy, which isn't to say that housing won't continue to go up. But, as I mentioned, we're more opportunistic real estate. The kind of returns we're looking for would be more like 20% over time. Other real estate investors are going to have lower return hurdles. They're going to be willing over time to pay more, and that's great. I mean, the idea is over time that you have a natural U.S. recovery.
And when you buy these houses, are you able to fill them with renters right away? I mean, is that a pretty fluid process? I mean, I guess how real, as you mentioned, how real is the demand side?
So the demand side is very real, but we actually don't rent them right away. So Invitation Homes has what they call a 300-point check system where they go in, repair. I mean, these are usually homes in disrepair. And so we end up, on average, investing about $15,000 per home to fix it, and then we lease it out. Because we have scale in regions, you can actually lease more quickly because you have scale with rental agents and all of that. So we've actually seen an accelerating rate of rentals by the week.